So, Neil, let's just start with how interesting that China's COVID lockdown hurt the demand for oil. China is, reopening and back in the driver's seat. So, what does this all mean for oil companies right now in China?
Well, it's a clear positive, particularly for the downstream companies. We saw Sinopec report results yesterday, and they guided to 7 to 8% growth in refined product demand this year. So, that's about 1 million barrels a day if you apply that to China overall. So it's going to be a very strong year for downstream demand. So if you are positioned in refining, chemicals, that recovery that you're going to see in demand for petroleum products going to be very positive, not just for volumes, but also for margins.
So is the frosting on the cake going ahead, and maybe not in the previous quarter, but going ahead, not a good situation for the Middle East, but the clash between Iraq and the region and the Kurdish regions that is continuing to boost prices? Is this price rise going to continue? And again, is this just going to kind of add some juice, some fuel to a gain in the profits for these companies?
Yeah, I think that, obviously last year was an incredible year for oil companies globally. I mean, we saw Brent average $100 a barrel last year. I mean, this year, we think we're going to be maybe somewhere between $80 to $90 a barrel, so maybe a little bit lower than last year. But if you look at the market dynamics, we're in an oversupplied market right now. But as we move into the second half of the year, the combination of growth that you're going to see in Chinese demand plus further curbs in Russian exports as a result of EU sanctions, should lead to Brent trading, higher than we're seeing right now. I think the biggest risk to that scenario is clearly if we enter some sort of recession in the second half of the year, and clearly those risks have increased since the start of 2023. But overall, I think the setup is still looking pretty constructive for oil.
When you take a look at the strength of the Chinese recovery, though, is there a fear that we're sort of pinning our hopes on an economy that even the recovery that we've seen so far has been weaker than expected?
Yeah, I think that's fair to say that, the recovery maybe has been a bit lackluster, but I think, we've got to give it, time. We're still at a fairly early stage in the recovery. But if you look at just the numbers, I mean, we actually saw, oil consumption decline in China last year. We hadn't seen that for, over 30 years. And if you look at just, consumption of, jet fuel, which was almost a third of what it was at pre-COVID levels, I mean, we're seeing a strong recovery in airline demand in China. You're also seeing increased demand for mobility really across the board, which is boosting, gasoline consumption. And if you look at the chemical sector as well, which has been a big driver of demand, there's a lot of capacity coming on this year that's also going to boost consumption.
Talk us through some of your picks across APEC in the energy space. For China, CNOOC was one of them, and you also like Woodside.
Yeah, I think, CNOOC and Woodside are really, two companies that you have to own if you believe in higher commodity prices. CNOOC obviously trades at a very large discount to its intrinsic, value being on the US entity list. And we see a lot of upside there, particularly with, free cash flow, almost close to 20% for that stock and dividends around, 10 to 15%. For Woodside, it's really benefited last year from, higher LNG prices as a result of, Russia's invasion of Ukraine. We've seen LNG prices come off in the first quarter on a milder winter in Europe. But as we go into the winter ahead, we see very little incremental supply coming on. We're going to see greater competition for LNG cargoes from China, and the overall situation still looks pretty tight in the market. So we expect LNG prices are going to come back again in the second half of the year that will benefit Woodside, which is really the premier LNG company in the region.